Good day, good people. Let's start a new topic on bonds. We want to be able to price bonds. We want to be able to find the value of bonds. But let's just have this lecture or this recording for a brief background into these bonds. What are they? What are bonds? Are they important? etc. What is the relationship between these bonds and the bond notes? All right, so a bond is a borrowing arrangement through which the borrower or seller of the bond, the one who sells the bond, is the one who is borrowing. Okay? Because what is actually selling is a piece of paper. When you give the money, they give you a piece of paper. So it is a borrowing arrangement where the borrower issues or sells an IOU document to the investor, the buyer of the bond. Okay? So bonds are debt securities with they are actually debt securities, or they can be called fixed income securities because of the nature of the coupon payments. Now, why issue? We said bonds, they are debt securities. What is the reason for issuing debt? Why have debt? If you recall from your accounting studies, preliminary accounting studies, when you're looking at the financing side, where you have got equity and debentures, those debentures are in essence bonds. There might be bonds. Are we together? So they are bonds. Why issue those debt instruments? Now, you issue those because maybe a firm wants to raise capital and it's fast. It might be fast to issue it via debt, via borrowing. Does not want to dilute ownership. The owners want to remain the owners. They don't want to dilute their ownership, percentage of ownership. They don't want it to go down. So alternatively, if they want capital, they look for bonds. They look for debt. So bonds can earn more money on the use of the funds in the business than the cost of interest on the debt. So debt can earn more money on the use of the funds, okay, in the business than the cost of interest on the debt. Okay, so the cost of interest is fixed, but what can be earned is more. So if you can earn more money from that capital, if you can earn more, which means you'll have more remaining for you and pay that nominal interest or that fixed interest. So you have more remaining for equity holders. Okay, so you can earn more money by debt. So in essence, you are getting money when you've invested nothing yourself. So you are getting money for which debt has been invested. Are we together? You have issued a bond and you have obtained the money. And you are using the money to buy capital goods, which will generate more cash flows. Now from those cash flows, you just pay the interest and the remainder is for equity holders. So that's another reason for issuing debt. That's another reason for issuing debt. Let's look at some of the terms we might use. When we're talking about the term of a bond, we're talking about the tenure of a bond. And the tenure of a bond is the length of time until the principal amount of a bond must be repaid. Okay? The maturity date, the end of the life of the security, the day on which the principal or the amount must be repaid. The face value of the bond, what the bond reads and what the investor receives if they hold the bond to its maturity. That's the face value or the par value of the bond. Now, again, why invest in a bond? The investment in a bond. Let's check who invests in a bond. Now, the one who invests in a bond is the one who provides the funds to the borrower. You are investing in a bond. Now, you invest in a bond to distribute risk across a diversity of investment holdings. Investors want a steady, reliable interest payment and return on their full capital and investment at the end of the period. You would have weighed here to say, what if I get into equity? Equity, you might get your dividend or not. But when it comes to bonds, interest is guaranteed. Whether the company is making a loss, interest must be paid. Okay? Interest is guaranteed. That will be part of the bond indenture or bond contract to say interest must be paid. Interest must come first. In fact, bond capital, when bond is in, you've used bond, it is called prior charge capital. It comes first in your income statement before you think of paying your ordinary shareholders. Okay, so you want a steady and reliable interest there. Coupon payments. These are amounts of interest paid. So if a 10-year 1,000 face value bond is issued at 10%, it means the 10% is the coupon interest. Now the coupon payment, it's 10% of the face value. That's the coupon payments. But usually in most cases, these are paid semi-annually. What is the price of a bond? When we're talking of the price of a bond, we're talking about the amount someone will pay for that bond in the open market. If you are to buy a bond in the open market, how much will you pay for that bond? That is the price for the bond. Now that price, you are not just told the price that to pay $50 or pay $70. No, you have to compute the intrinsic value of the bond. What is the correct price of the bond? So in this course, we need to be finding the correct prices, correct costs, intrinsic values of certain securities, so that we are able to tell whether the securities are mispriced or correctly priced. Now, if they are mispriced, it will help us make a decision. Should we go long? Should we buy? When I'm saying going long, we are saying, should we buy? Or should we go short? Or should we sell? When I'm saying short, we're saying, should we sell? Should we get rid of the security? YTM. When I'm talking about YTM, that's the yield to maturity. We are saying if you hold the bond until it matures, what would be your equivalent return? What would be the return? What would be your yields from holding such an instrument? That's the yield to maturity. Normally, the yield to maturity, if a bond, for instance, is issued at 10%, or was issued at 10% last year, then this year, a similar bond has been issued, but now it is paying 7%. It means now the YTM, the open market rate of return for the bond, is the YTM. Okay? That is the yield to maturity. Now, how do you know which bond to invest in? Normally, you look at the ratings. But do we have any rating agencies in Zimbabwe? So, when we're talking about the ratings, we are saying it's an evaluation of the possibility of default. We are looking at the probability of default of the issue of the bond. What is the creditworthiness associated with the issue of the bond? It is based on analysis of the issuer's financial condition and profit potential, or how have they been performing in the past. Who provides these bond rating services? I want you to research on that one. So some bond ratings start at AAA and may go up to D, depending on who is issuing those ratings. Now, remember in our previous lecture, we were talking about the risk-free rate, where we are saying the probability of default is 0. The rating there would be AAA rating. The rating would be AAA rating. Now, which bonds are currently in issue in Zimbabwe? I want you to go and check these bonds and check the terms. What is the face value? When are they maturing? What is the coupon pay? What are the equivalent coupon payments? What are the coupon interest payments of those bonds? Are they a very good hedge against inflation? I want you to check which bonds are currently in issue in Zimbabwe. Now, types of bonds. We've got municipal bonds, treasury bonds, zero coupon bonds, junk or speculative grade bonds, international, catastrophic bonds. Municipal bonds, as you can see there, they can be issued by municipalities. If, for instance, the municipality of City of Bulawayo wants to raise money so that they construct a dam somewhere along Ncema, there, lower or upper Ncema, they might borrow, they might get into the market and borrow. They issue a municipal bond, a BCC bond. Now, if they issue that bond, payments or coupon payments might be obtained from the rates. Okay? Municipal bonds, they issue. If they want to rehabilitate the roads, if they want to upgrade certain things within the city, they can issue a bond. They can borrow. They can ask for borrowing powers from the Ministry of Local Government and Ministry of Finance, and then they borrow. We've got treasury bonds where the government is the one which is borrowing. Okay, now these ones are normally AAA rated. We've got zero coupon bonds. We've got junk bonds. These are normally issued by corporates. We can have international bonds. There are a number of examples there. We can have catastrophic bonds. I want you to go and dig deeper and check what are some of the characteristics of all these types of bonds. I just want you to say something on these types of bonds.